Are we about to see one of the biggest bond market freakouts ever, with huge debts needing to be refinanced and Donald Trump testing the waters about what to do with Jerome Powell? What's in store next for markets? And as we know, big tech is about to kick off. So, as we hit cross-correlation across the Nasdaq, a breakout in hyper stocks and retail traders taking massive leverage, and a really interesting read from Bank of America when it comes to cash on the sidelines, what's in store next? In today's video, we break down stocks, commodities and cryptos to really take a look at what's going on underneath the hood and whether we could be in for a massive seasonal event. Guys, this one's not to be missed, and we'll see you in a moment. There's a lot to break down. Well, welcome back everybody to the Daily Show. It seems like it's the calm before the storm when it comes to markets because of course we have been seeing some big news when it comes to the macro, the data and the key flows. To kick things off in today's video, let's discuss though the big topic that's been boiling around, and that is, will Trump potentially try to fire Powell? Now technically it's not allowed, but his tenure is up in 2026, and we saw an announcement some kind of announcement over the last 24 hours where the White House said Trump will fire Chair Jerome Powell, and the market instantly tanked off that news. Then Trump came out and denied the rumor, and it was all the way back. But this actually sent a couple of large transactions through. In fact, we saw a huge one on VIX futures, and it came in just before Trump came out and said, don't worry guys, just a joke, I'm not doing anything in particular. So clearly this is like a calm before the storm. The market, it doesn't have much volatility in right now, but there are signs that problems are around. And this happens, of course, every year sometimes around this particular area. Q3 in particular is a dangerous period. August, September, October. 3 of the weakest months of the year, September being of course the worst overall, often trigger what we call sell signals. And according to the latest Bank of America report, it looks like the FMS average cash level has dropped under one of the most important reads, and that is 4%. Now when we tend to get underneath here, we've only seen it a couple of times. 2021, we all know how that played out. 2000, 2007, and indeed actually earlier this year when we were talking about it in February of 2025, just before we start to see the market sell off indeed. Now why is this important? Well, it's one of those points where you've got to start bringing together the signs and the pieces of the puzzle. And we'll talk about seasonality if you haven't been watching the videos for a while a little bit later on today's video. But before we go down that line, I want to talk instantly here about liquidity. Because over the last 24 hours, we've seen quite a lot of announcements from, let's say, China, and big information starting to come out for Baba, which is, of course, Alibaba, one of the most well-known stocks. They seem to be settling a bit of a case that's been going on for years to do with Ant Financial, and we're starting to see the signs of pickup when it comes to liquidity. And one of the things we've been talking about now for over a year has been the significant amount of liquidity that's been injected into the Chinese markets. And this has led into, of course, overall a fairly bullish recovery, which is now currently testing a huge resistance point. Now, why is this important? Well, we've seen a couple of large dark pools, and most recently around July 9th, we had one of the largest dark pools ever on the China Bulls 3 times levered ETF. And so far that's been, as you guessed it, pretty damn good. Now, why is this? Well, often Wall Street moves in mysterious ways, but generally they have to show their footprint. If anyone's familiar with Wyckoff, you may know that generally speaking, markets will show their footprint in large volume or kind of big trades that are clumped together through the dark pools. And we often see this, and we obviously cover it on the channel. But while we haven't seen one currently really to note on the highs here for the S&P, we are starting to see signs of things cracking underneath. Most notably of that was, of course, this week's inflation report. And while the market didn't worry about it, clearly it's showing that some forms of inflation are coming back. Whether it's appliances, whether it's laundry equipment, or even household furnishings and supplies, there's clearly a bit of an uptick because of the tariffs. And most inventories seem to be around 4 to 6 months at this stage, with even some up to 12 months. So it always lags and it always is delayed in terms of when you see a tariff implemented and when it actually starts to take effect. This could be a storyline, I believe, of the next couple of months, and of course it's something we're looking at. And it's causing problems across the board. Not only is cash at all-time lows in terms of the Bank of America survey there that we saw, we're also seeing liquidity declining in the bonds market. And as you guys know, the bonds market is arguably the most important debt market in the world, and it's just not the same as it used to be. Now, this has been a spike in 2025 driven by geopolitical concerns and of course predominantly just driven by all sorts of concerns about US debt. And this is making an illiquid market. And that's one of those markets that is susceptible to flash crashes and big events. Now, it's not to say it's going to happen tomorrow, as these things are incredibly difficult to predict, but at the same time, it's something we want to be aware of. And as we've talked about recently, we've been rallying up higher to make new highs, which is definitely not a bearish side, but we're starting to hit those correlation periods. Whether it's the S&P 500, NASDAQ, Russell, or even US dollar, all of them are kind of at those critical levels where you expect them to start to find potential flips. And as you guys know, this tends to happen around the seasonality of the current period. Now, new highs tend to happen in clusters. So the good news for the bulls out there is that it's unusual to see just 8 in terms of new highs. And that's all we've got here so far for 2025. I guess we've almost got 9 now. But we usually start to see upwards of even 50 new highs as they start to come through. So why does this count? Well, of course, if we see a pullback, we know that Wall Street hasn't purchased enough, especially the hedge funds, when it comes to these markets. Then what we're starting to see is a sign of rotation. So big tech stocks have been doing really well. Semiconductors obviously been leading the market. That is usually what you expect. 83% of the time, in fact, big tech innovation stocks lead everything that we see around the world. But what happens when we start to see commodities pick back up again? And could this be concerns of reinflation or stagflation? Well, we have a CPI number that's a little bit hotter. And of course, now we have commodities, excluding gold, as you can see here from top-down charts, showing a ratio that has traditionally been where we start to see a pickup in the harder metals. Aluminium, iron ore, these types of metals often do start to run off these points. And we're already starting, rare earth minerals and metals have already started. And obviously there was a huge announcement between Apple and MP just 48 hours ago. So with retail traders going ballistic, buying into everything and buying every hyper stock you've ever seen, it seems to be like 2021 again. Similar types of cash ratios, similar types of leverage, in fact even more leverage in the markets, and a correlation point. So is this normal? Well, it is pretty much what exactly happened during the dot-com boom. We were bubblicious. That was that stocks became concentrated. Again, if you don't know your stat right now, the top 10 stocks in the S&P 500 make up 37% of the index. Last time we saw that was this 1998 to 2000s narrative. And of course, this means that we're in that kind of final stage of what we call a bull market. And that's been probably exemplified by the financials starting to underperform recently. If you don't know about financials, they tend to be a mid-cycle play. And at the moment, we're in a point where mid-cycle plays such as financials have started to decline and underperform. What is performing? Tech, hypergrowth, any business that was kind of like a 2021 business, it seems, and they've all been picking up. So as you can see with this 98% correlated chart, we come into a period here of usually lackluster returns, whether it's a pit, which is sideways, or a pullback, which is more traditional with this period of time in the year. One of those two things could potentially be on the horizon. And it leads off that Christmas in July. Now on the 15th of July approximately, we usually start to see the topping of a market if we're going off history from 1985 to now. You guys already know this because I bring it up in many of the videos, but it's obviously a sign of caution, and of course this makes sense to the choppy year that we're currently seeing. The good news is going to be tech. It's expected that tech earnings will be good, but has the market priced in what we call perfection? Many experts out there will say it's priced to perfection. You've probably heard the term before, but it kind of really is. Forward PE ratio is getting very close to being the highest point we've seen, not actually had since 2024. And it means that each and every earnings counts. And over the next 24 hours, we'll see a couple here. TSM, Netflix, and a few others. Just remember, guys, when it comes to these earnings, it's all about the expected options moves. If you're not familiar with them, make sure to follow this channel because, yeah, if you're not aware of Netflix being a +-8 according to the options market, then you may not be aware that that could happen and you're in the wrong side of the position and it could blow you out. In terms of which positions are most bought, which positions are most sold, according to Goldman Sachs' latest report, these are the implied moves and these are the crowded longs and crowded shorts for some of the most popular sectors and stocks. So be aware of them and make sure you're, of course, checking them out. Now, one other thing I just want to remind you guys of, I'm always posting over on LinkedIn now, and I'm sharing there a bunch of psychology, a bunch of stories, and a bunch of other information that's really helpful for you as traders and investors. Completely free to follow, so do so by checking out the pinned comment down below, and make sure to check out, of course, some of the extra information that we've got there. Now let's jump into the charts. The big one here is, of course, the S&P 500, and you guys know that it is on that trend line. We are at that point where we expect sideways market action, that is a bit of, rotation to occur, potentially into metals as well, and then, or we expect kind of markets to come down to key levels, particularly the anchored VWAP and weekly 20 moving average, which currently sit around 6,000. So that would give approximately from the high here a 5 to 6% pullback. Now, some people expect upwards of 10% pullback during this time, but just remember, be flexible. The market rally didn't happen for no reason. It is very bullish on currently AI growth, and of course that's the big thing here leading these markets up. When it comes to US 500, it is incredibly trapped. You can see here the news when it came out that Jerome Powell might be getting kicked by Trump. That really did start to freak the market out straight away, and then of course it was instantly reversed. But I think this is a story that's going to continuously come up over the next 6 months. You're going to see a lot more comments around this, and of course you're going to see a lot of speculation each way. I always say the big thing is follow the flows, not the speculation or